Hi, I'm Brandon Bestian. I'm going to talk to you today about investing in real estate. I started investing in real estate 20 years ago, and when I started, I had no money, no assets, I had nothing. In fact, I had less than nothing because I owed a whole bunch of money. And I'm going to show you how I analyzed deals so that I quickly knew if the deal I was looking at was worth going out and driving out and looking at it in person or not. So the term that we're going to learn today is called cap rate, which is short for capitalization rate, and it's the number that we're going to get to identify if a property is worth looking at, whether it's commercial, multifamily, be an apartment complex, or a mobile home park. It really works for almost any investment, including businesses, except for single-family houses. Single-family houses are a little different on how you figure out if they're worth investing in or not. But this is going to take anything other than that, other than single family, and it's a quick number to find out, is this worth me pursuing, or am I going to make money on this property? So I'm going to use numbers from an actual deal I did several years ago. These are the actual numbers from this deal that I ultimately ended up purchasing. So in this deal, I had 16 one-bedroom apartments. It's a 32-plex. And I had 16 efficiency apartments. The one bedrooms rented for $380 a month, and the efficiency apartments rented for $337 a month. So the first thing you have to figure out is your GOI, which is your gross operating income. This is all the money that the property takes in, everything. So in this case, we're going to have our gross rents, and then we're going to add some other things like laundry income into this deal. So to get to my gross operating income, I take $380 a month times 16 times 12, because there's 12 months. So on my one bedrooms, I grossed $72,960 a year. On my efficiency units, I grossed $64,704 a year. So my rent total was $137,664. Now that's great if you keep them rented 100% of the time, which is actually possible, but you want to figure in some kind of a vacancy factor. So in this particular deal, I figured in a 3% vacancy factor. So I subtracted $4,130 for my 3%. And the vacancy factor here in the Black Hills, things stay full pretty much most of the time. So you're gonna not have a very high vacancy factor unless you have a really crappy property, quite honestly. So the other income I added back in was I had $1,700 a year from laundry, because in this particular multiplex, I own the washers and the dryers, and they fed them quarters all day long. So my total gross operating income was $135,234 a year. So that's the first important number we need to figure out. The second number we need to figure out is our expenses. So all of our operating expenses, we're going to subtract from our gross operating income. So we had electricity, gas, water, sewer, garbage, repairs and maintenance and supplies, property taxes, insurance, and advertising. So for my electricity for the year, I had a figure of $8,388. For my gas, I had $5,284. Water, sewer, and garbage was $7,620. Repairs, maintenance, supplies was $6,000. My property taxes were $22,000 a year. Insurance was $1,800 a year, and my advertising was $250 a year. So my total operating expenses were $52,242 a year. So the most important number I'm looking for is my NOI, my net operating income. So I take my gross operating income, I subtract my expense totals, and my NOI on this deal was $82,992 a year. And that is the most important number we're looking for, is NOI, and then this is how we get our cap rate. So in this particular deal, The asking price of this property, when I negotiated it down, it wasn't the initial asking price, but where I ultimately negotiated it down to, was $550,000. So to get my cap rate, I divide my net operating income by my purchase price, and in this particular case, I came up with a net operating income, or excuse me, a cap rate of 15%, just a little bit over 15%, which is, for this area, is a very good cap rate. Now, this was not an advertised cap rate because most cap rates are advertised 8% or lower in this region, but by the time I revamped some of the numbers on where I knew I could operate on a more efficient level, I was confident and comfortable that I could get a 15% cap rate. So this number is the critical number we're looking for, and I can tell you from personal experience that if you're doing something that's 100% financed, $1 million or less, you need at least a 14% cap rate to break even. Now I realize that people are going to say, well, you can't do 100% financing, and there are many ways to do it, which I'll explain those in future videos, but the most important number to know is 14% cap rate or higher will be a break-even type of property. So then, once we get this number, we can take our purchase price, we do our PITI, principal, interest, taxes, and insurance. We get that number. Actually, we already got insurance and taxes in here. We get our principal and interest number, and we know if this thing's going to cash flow or not. So that's how you figure out cap rates, and we'll talk about some other ways to figure out commercial real estate investments in the future.